All right, so welcome back, everybody. We're about to get started. We're going to switch gears a little bit now and talk about alternative private equity business models. Ted and his team are going to share what they've learned over the last several months as they've been exploring alternatives to the way we're currently investing in the private markets. Before I turn it over to Ted, I do want to ask the board members and executive staff here, please no questions until John Cole finishes his presentation and we move on to the next panel. He's got quite a bit to get through, and we don't want to break his concentration or his stream there. So, Ted, go right ahead.
Thank you so much for that, for both the comment and helping John with his presentation. It's lonely to be the only one up there, but he can't handle it, and we've been on quite a journey the last 9 months to really scout people and talent and information from all over the world, and to coalesce that and bring it in a coherent fashion to the board to talk about how we invest in private equity and what some of the alternate business models that are available to us. Because at the end of the day, we do feel very strongly that investing in the private markets in general and private equity are really a necessity for us. For CalPERS to be successful in meeting our investment objectives over the course of not only this next asset allocation cycle, but into the next 10 years, 20 years, 30 years, and in perpetuity, really. It's too important part of the market, it's too much talent in the market, and too important a piece of our overall portfolio construction. But it comes with all of the issues that we've talked about so many times, and this opportunity today is clear our minds a bit. And in fact, in my 15 years with CalPERS, we've from time to time wrestled with the question of how to perhaps pursue some alternative ways to invest in private equity, and I think we've always kind of come up to the finish line and stopped short of really moving forward in any particular way with any scale or force behind it. So I think, as I said, we can clear our heads. This opportunity is really, as a board, as your staff, to think through what is available to us, hear the best advice. We have two great panels ahead of you today. Those will be a time to ask lots of questions of people that are really valuable assets to you in bringing and answering questions to the pros and cons of the different business models. And with that, you're also lucky to hear from John, and I just really appreciate his taking his total fund hat and putting it on from our public equity portfolio and really diving into the private equity world. So with that, John, the stage is yours.
Thank you, Ted, and good morning. My live. John Cole, CalPERS staff here. Our topic is alternative private equity business models. A great deal of effort has been invested in taking a fresh look at the private equity industry, our CalPERS history and current positioning, and a range of potential options we might consider for the future. I'd like to start with the punchline. We believe that continuing success in private equity and direct investment in private companies requires a robust and scalable presence. In order to get there, we'll need to do a number of things well. There's not a single model that will suffice. In fact, as we will discuss, the combination of fund-to-funds, investing in funds offered by general partners, participating in co-investments, and establishing separate investment vehicles will all be necessary to meet our objective to effectively access private equity returns in scale. Today, our private equity exposure include $26 billion invested and $14 billion in unfunded commitments across 347 managers, with 92 being direct relationships with managers, and the rest are managers within funds of funds, fund of funds. The private equity weighting within the total fund is about 8%. Today we'll start by reviewing the work and conclusions from our strategic review of private equity. That will be followed by a panel discussion led by Ted on the role of emerging managers within private equity. That should get us to lunch, after which we will describe a range of alternative approaches along a continuum. Please note once more that discussion assumes that we will not and cannot rely on a single business model. Instead, we believe in a combination of approaches which can complement one another as a total strategy and help us fulfill our overall goal of a meaningful presence within private equity and a better chance to achieve our 7% expected return for the total fund. A highlight of today is to tap into the extensive knowledge and experience of our afternoon panel, who will discuss their views about the major opportunities and challenges that CalPERS should consider. This is where we will discuss the pros and cons associated with our choices. Our desire is to have an active dialogue, but caution that we have a great deal of material to cover, so I thank you in advance that we can postpone discussion this morning in order to allow the broad interaction to occur later today. At the end of today, we hope to gain a clear sense from the board on how best to proceed in the development of incremental capabilities in developing an overall private equity strategy. So off we go. Here on page 3 are several graphs to refresh our positioning and experience. The top left illustrates the proportion of the total fund represented by private equity. It is misleading to say it was our desired allocation because much of the time it was a result stemming from private market conditions and when investments were actually made by the general partners, and also the impact of the public market price movements. The graph below it illustrates vintage year commitments. Vintage year refers to the year that commitments are actually made to private equity funds. You can see in the bottom left graph that our record has been quite lumpy, with large commitments in 2006, 7, and 8, followed by notably smaller amounts in the intervening years. The topic of vintage year deployment will itself be touched upon specifically during our afternoon panel discussion. This graph also shows the net cash flows we've experienced over that period, shown by the red line. When above the 0 point, it means we've received more back in distributions than we provided in capital contributions in that year. The past 6 years have seen significant net return of our capital. The top right graph tracks the 10-year rolling excess return of a private equity index versus 2 other lines. First, a global public equity benchmark, that's represented by the green line, and a broad public U.S. equity benchmark, that's the orange line. Over the past decade, although the excess return has diminished somewhat, especially versus the strong U.S. public equity performance, it appears to have settled into a roughly 2 to 4% range, depending on the timing and the benchmark you choose to look at. Finally, the bottom right seek out highly valuable, repeatable cash flow opportunities. 4 months ago, we commissioned a comprehensive review of our own book of relationships and our history with the help of Hamilton Lane, a respected alternative investment management firm providing private market services to sophisticated investors. A firm which has known the private equity marketplace and its players, and specifically CalPERS, for many, many years. One deliverable from Hamilton Lane is an analysis of our strengths, weaknesses, opportunities, and threats, shown here on page 5. The highlighted boxes are those characteristics which fall within several categories, that the little yellow highlight. For example, our brand is a strength in so much as we have a high profile, institutions pay attention to what we say and what we do, and we have the opportunity to be innovative. On the other hand, our brand is a weakness because we are often judged to be difficult to work with, often unpredictable in our commitments, inconsistent in our messaging to partners, and questioned about our ability to make timely decisions, all of which have contributed to CalPERS being excluded or curtailed from investment opportunities with a number of very successful potential partners. The opportunity for our brand is to address those weaknesses, to be, one, to be clear about our strategy, two, timely in our ability to make decisions, and three, focused on long-term outcomes as we endeavor to create better alignment with our partners. Achieving an overall balance is needed to allow us necessary access to the appropriate talent, both within CalPERS as well as external to CalPERS. We must use our brand as an asset that helps us meet our return requirements with consistency and continuity, and allows our effective time horizon in private investing to be lengthened, consistent with our needs and opportunities, not the needs and opportunities of others. Another broad SWOT example is size, which is highlighted across the board on this page. Let's go through the thought exercise as to why it belongs in each category. It is a strength in presence and profile to be large. It is a weakness to have the pressure to invest large amounts of capital continuously and with little negotiating leverage in a seller's marketplace. Our size can provide an opportunity to create meaningful strategic partnerships with select counterparties, and it is a threat when we are subjected to the ramifications of a negative brand reputation. Among other strengths that we found is the cumulative knowledge gained from 25 years of private marketplace participation. Also, because many yet consider CalPERS a thought leader, we have unusual access to innovative and creative investors, valuable if channeled into supporting a clear overall strategy or providing better execution. Program flexibility describes the breadth of relationships that we have developed over the years. And in weaknesses, they include the strained or non-existent relationships resulting from the negative brand perception that I noted earlier. A number of successful GPs have told us that we have become too unpredictable to do business with, and many larger general partners are cutting back the amounts that they are willing to allocate to us within their new funds. Also, as CalPERS moves to a more concentrated portfolio of relationships, there will be a large number of residual relationships which will form a legacy portfolio, which carries with it a specific set of challenges and issues which will take great effort and expertise to be managed. Governance is widely viewed as a weakness, again, due to our perceived inconsistency, unclear expectations, and strategies signaled both by the board and the staff. Transparency is a weakness resulting from our tendency to attract attention through headlines rather than behind-the-scenes engagement. One lesson for CalPERS over the past decade, especially in corporate governance space, has been the effectiveness of private engaged investing over our prior strategy, which name and shame philosophy. And I think that applies in parallel. Opportunities count long-term ownership as a particular chance for CalPERS to have a Warren Buffett-like approach to finding great companies, both public and private, that we can own in a material size for a very, very long time. That is a huge advantage if properly sourced and governed. Our platform provides great breadth to access global investments, and if buttressed by a clearly articulated strategy and effective governance structure, we could become an investor sought after by many long-term corporate managers and boards. California is in this column of opportunities because we could be doing so much more here in our backyard, especially in areas like venture capital and infrastructure. Tremendous potential exists if we can address our weaknesses and if we can establish one or more separate entities that can be expressly run like a business, including having an independent board and staff to be able to attract, compensate, and retain talented investment professionals while having a very well-defined mandate from CalPERS. Although this may open an uncomfortable conversation about governance and the board's role, we think it's a very important discussion to have and can be resolved successfully. A separate entity can provide the independence necessary to reap the benefits of our size. It allows us to address how to attract, compensate, and retain talented investors. It allows us to be viewed favorably by prospective partners, including portfolio companies. The governance should be robust, as we insist in our own engagements with companies around the world. We will need to be comfortable with setting up such entity that we would incorporate our own goals, our values, and our expectations, including reporting requirements in its very mandate. Then, however, it needs to be organized at arm's length in both its board and management and allowed to run as a business without interference. We will own it, and accountability will come from our ongoing decisions to fund it for long-term investments, which, by the way, gives much more control than when we commit today for 10 to 15 years to a fund managed by an outside general partner, where we have little or no influence over when and how our capital is invested. So we need to have this discussion today and understand how it affects our brand, our access to talent and investments, and our ability to invest in scale needed to move our needle. This should be a large part of our focus during the afternoon panel discussion, and we have a tremendous panel to help bring that to bear. Finally, the threats facing CalPERS. They form the backdrop for the challenges that accompany us because of our size and our brand. Some are outside our control, but all should be taken into account when implementing our own strategy. The next slide is taken from the discussion with Professor Josh Lerner at the November 2015 Private Equity Workshop held with the Investment Committee. Professor Lerner laid out 5 characteristics of successful LPs. They are: 1, having and articulating an overall private equity strategy, importantly, both internally and externally. 2, having a reputation as a good partner, as part of our brand. By the way, being a good partner means many possible things, but most important is that we are respected, we can achieve synergies, and drive together our relationships to mutually beneficial outcomes over the long run. 3, having staff or accessing external resources with industry expertise that will provide consistency tied to our overall strategy. 4, being able to make decisions by the right people in a timely manner. And 5, having a mechanism for ongoing self-examination in place. We believe we have the potential to materially improve in all 5 of these characteristics. Now turning to our review. About 9 months ago, a small team, including Matt Jacobs, our general counsel, Mahbub Hossain from our private equity team, and Kaba Cha from our real assets team, Ted and myself, worked to identify up to 50 respected professionals who are directly or indirectly attached to or affected by the private equity markets. The list included well-known public CEOs such as Jeff Immelt at GE, Jamie Dimon at JP Morgan, Larry Fink at BlackRock, noted academics, again visiting with Professor Lerner, sometimes CalPERS critics, Professor Ashby Monk at Stanford, and Professor Ludovic Philippou at Oxford, global investors and conveners such as Michael Milken, notable large GP founders like Steve Schwartzman at Blackstone and Leon Black at Apollo, and sponsors like Raz Husseinian, formerly of Wilshire, now CIO of the Helmsley Trust, and a host of other respected, thoughtful, opinionated leaders. We sought diversity of background, thought, and perspective. We asked each of these people to put themselves in our shoes with our mission. What would they do? We asked them how they envision the private equity business changing over the next 5 to 10 years. And from those conversations came a whole range of themes. Always mentioned was the necessity of appropriate governance, meaning allowing effective execution of a well-defined strategy. Also, having a good decision-making apparatus and consistency of message combined with continuity of people. Everyone emphasized finding the right talent, the critical importance of attracting and retaining the right professionals for the strategy, whether internally or engaging externally. And almost always, our opinion leaders emphasize the topic of using more to our advantage, our long-term investment horizon. Next, we heard the acknowledgement that fees remain where they are, high. And so does the difference between high performers and low performers. Many peer institutions are seeking more use of co-investments. That is the opportunity to invest alongside general partners at no fee as the best way to average down their overall fees. This is rapidly gaining interest among limited partners, which raises the question of whether these opportunities may become overcrowded and as a result potentially suffer adverse selection in the future and result in lower returns and/or higher risks. Surely, having the appropriate talent to assess deals and the right partners to source deals are both prerequisites for success. The subject of negotiation often came up. Namely, it is currently a seller's market, with the best GPs having an abundance of capital available to them, thereby shifting the negotiating leverage strongly in their favor. This may change sometime in the future, in fact, is likely to, but it is a fact of life today. The issue of internal talent versus external talent was also raised. Can large public institutions compete for the talent needed to provide the necessary continuity, consistency, and skill to implement a long-term strategy, especially within the constraints of compensation that we and most institutions live with? These are clearly important considerations and lead to analyzing the challenges and prerequisites of some form of a direct investing model. We will get into that with much more detail with the panel after lunch. And there's more. On page 8, what is the likelihood that the excess returns enjoyed from private equity will continue? Although we believe there are good reasons they will, is there or will there be too much capital or too many participants chasing deals, with the results being higher risk and wider volatility of returns? Related to that is the reality that regulation, activism, short-term investment horizons, high costs of being public and external distractions have resulted in thousands of companies across the capitalization range going away or choosing to go private. Over the past 20 years, U.S. listed companies have gone from over 7,300 to under 3,700, nearly half. In the case of entrepreneurs and venture companies, many are choosing to stay private longer. In fact, today, there are about 174 unicorns. That is, companies that are private and have an implied market value greater than $1 billion. By the way, this is another piece of evidence arguing for longer-term horizons in developing new companies. Next is the rate of change in an age of acceleration. That topic, I think, is worth a workshop on its own. But generally, the changes occurring in technology and life science, just to pick on two, are happening at a rate akin to Moore's Law. And that has huge implications for CalPERS' long-term strategy. 3 great books on the subject are Tom Friedman's Thanks for Being Late, Vivek Wadhwa's Driver in the Driverless Car, and Calum Chase's The Economic Singularity. This is a trend that should change the way we think about venture capital for CalPERS and, in fact, all of our longer-term investing. Next is the significant migration of top operating executives out of public companies to private equity assignments that is dramatically impacting the balance of competition between public and private companies in the marketplace. Somewhat related to that are the potential disruptions that may occur as the first generation of hugely successful private equity firms face their transition to a second generation of leaders. There is likely to be material dislocation and change. Talented professionals may go elsewhere, cultures may change, and firms may be challenged to maintain their momentum. This happened in the public equity markets during the 90s and had profound impacts, and is likely to occur in the private markets over the next few years. Another dynamic is an accelerated move by large, successful private equity firms to take their own companies public, or in some cases, seek private investors in their own firms in order to provide liquidity, as well as offering some more alignment between investors and the general partner. The question of whether this facilitates better alignment or creates agency problems remains a complicated one, but an important one to consider. Owning these equity positions is a viable alternative to investing in their funds. Shifting a little bit, often in our discussions, parallels have been made about how the private institutional real estate business has evolved. One example being the willingness of real estate general partners to be more specialized and captive to a large capital provider, alleviating the need to be raising capital constantly. Another parallel is the potential establishment of an operating or investment company, a separate, independent legal entity, like we have at Centerpoint in our real estate area today. Centerpoint is managed by an external partner, and it has an independent board and an independent staff. Other examples of captive companies are interesting. There are more than a couple, such as Cadillac Fairview, owned by Ontario Teachers. There are a number of parallels within real assets from which to learn in developing our overall private equity strategy. And clearly, having an independent, separate entity or entities and owning assets with an indefinite time horizon are two things we think we should do more often. Next, I'll turn to a little different dimension. It's a demographic observation. The millennial generation, those now entering their professional years in their 20s and 30s, seem quite distinctive as a cohort. They will have a strong impact in the near future on how companies are managed, how investors behave, how professionals plan their life and career. This idea will also be taken up in the afternoon panel with some particularly provocative observations about this. Moving along, among our listening tour conversations, many discussed the Buffett model of owning great companies indefinitely, both public and private, as part of a long-term strategy, taking advantage of our long-term investing horizon. Ed Gottesman, our afternoon panel moderator, will bring light to this later, I'm sure. And finally, cost versus returns. It's a given that we and all organizations, especially those managed for the public trust, have an obligation to negotiate for appropriate low costs. But a balance always needs to exist between lowest cost and best outcome, often the difference between winning in the short term and accomplishing our long-term strategy. It was often reminded to us that this is difficult and an ongoing challenge that requires at the same time vigilance and a true long-term view. So with that, I'll introduce one more slide, which I'll spend just a few minutes highlighting when we return from lunch before turning over to our distinguished afternoon panel. Here you see a business model continuum with several types of strategies. They are not mutually exclusive, as I mentioned up front in my remarks. In fact, we believe that we will need to pursue most of them at an appropriate level to accomplish our overall mission, to achieve our 7% expected return. Now, I'll turn it over to Ted and then to introduce and lead our morning panel on emerging managers, which will include Derek Jones and Sarah Kaur. Emerging managers, and particularly the use of fund of funds there, have been and will likely continue to be an important element of our private asset class investing. Ted?
Great, John. Thank you so much for that and for your partnership in this endeavor the last 9 months. Let me give some time, Derek. There we go, Derek, and members of the panel, please come on up. And while they're, actually, I'm going to scoot down one more, so I have you all on my left. And while they're coming up, this is a bit of a scheduling, or not scheduling change, but makeup of the panel change. You'll notice from your board books on the agenda, we had planned to have, and I'll make introductions in a second here, Derek from Grosvenor, as well as Sylvia Bell from Texas Teachers, and she had a last-minute personal family matter she had to attend to. So we're very sad she couldn't make it, because she brings a very interesting perspective from a very robust and respected institution, Texas Teachers. But what we've done on the fly here is put together a panel to give, hopefully, that perspective in a different way for everyone here today. And really, the topic for this panel is really starting off on the left-hand side of the business model continuum. We'll talk about fund of funds. So this is the point of the day that we're going to talk about the fund of fund as a model, its constituent parts and the benefits and costs of that model and why we do it. And in particular, on the why we do it, is it's a model that we have used in the past and plan on using into the future to access emerging managers. And I know that's a topic we've had lots of discussion here, and there's lots of familiarity with this board of the emerging manager programs at CalPERS over time, as well as emerging manager investments across the country. I've seen many of the board members at at conferences that I've attended, so we're not going to go into too much detail in terms of what is an emerging manager and how are those programs done. This purpose of this panel is really to look at the intersection between what we're hoping to achieve in an emerging manager program, and particularly CalPERS Emerging Manager Program, and why we've chosen and many others have chosen a fund-to-fund model as a business model. So with that as the preamble, I think everyone knows Sarah Kaur, our interim director, managing investment director of private equity. She graciously agreed to step in today. And then in the middle, Derek Jones, who I've had a great time getting to know and talk about these issues over the course of the last 9 months. He is a principal at the Grosvenor firm, which is the fund-to-funds firms that CalPERS has selected to manage our emerging manager program going forward. And he's joined by his colleague, Jason Howard, who I've also had a chance to meet and discuss these issues with. So we're delighted to have the panel with us. So why don't I just kick it off here, and perhaps probably the best thing to start out with, Derek, why don't maybe you can introduce yourself and Grosvenor a bit to the board and the mandate, the emerging mandate that you have with CalPERS.
Thank you, and thanks for giving us a reason to come to Monterey. Again, my name is Derek Jones, the Managing Director of Grosvenor Capital Management. It's an alternative investment asset management platform. We have approximately $50 billion in AUM. We provide customized solutions for institutions who want exposure in alternative investments. And we span the liquidity spectrum through our allocation to best-of-breed hedge fund managers, which are the most liquid strategies, to our private equity business, broadly defined, which are buyouts, venture, private credit, infrastructure, real estate, co-investments, and secondaries. We are particularly known for our work with emerging managers, as Ted said. 50% of our allocations on the private equity side to primary funds are to emerging managers. We define emerging managers as funds that are raising $1 billion or less. So because of that work, and because of almost 2 decades of experience, we manage a variety of emerging management programs across the country for institutions, including CalPERS, so thank you for the business. We're currently investing a $200 million mandate over 4 years, but our client base really ranges in size in terms of commitments. We have a client where we're investing $500 million a year behind emerging managers. The 2 groups that I run our co-investment practice, which is where we have capital set aside to opportunistically invest alongside any one of these managers in the case that they need extra capital to get a deal done. I also run a focus group called our diverse manager practice. And that's where we are scouring the country looking for the best women and minorities who have to be raising a private equity fund. I'm joined here by my colleague, Jason Howard, who's a partner in the group. He works very closely with me in both of these verticals. So thanks for inviting us.
Great. Derek, great, thank you. And Sarah, maybe hit on just briefly to remind everybody the size of our exposure in emerging managers and the mandate with Grosvenor, just to go over the size numbers again as an introduction. Oh, I have to share the mic.
So the mandate with Grosvenor is there's 2 funds. There's a $100 million commitment and a $200 million commitment. That's in the context of our total emerging manager portfolio, which is about $4 billion of NAV and just over 70 managers.
So why don't, with that scene setting, and you can see it was we reassembled this team quickly. The name tags are coming out as we speak. Well, let's just talk a little bit about the reason limited partners in general, and we'll get to CalPERS as well, establish emerging manager programs. I'm going to give Derek, maybe I'll kick it off you, Jason, kick it off, thoughts about the benefits or the rationale for it.
I think there are a variety of reasons to establish an emerging manager program. As fiduciaries, I believe it's our responsibility, as well as the clients, to make sure the broad net is cast to find the very best managers in the country. We have found through our experience that you can get an appropriate risk-adjusted rate of return in the emerging manager space. Often it's very complementary to our clients' private equity portfolios because they're mining in very different areas. They're mining in the middle market, they're mining in the lower middle market. There are a ton of operational inefficiencies. These are founder-led businesses, family-owned businesses, where there are pretty proven ways of establishing value creation with those companies. And so we like that. We think that you can purchase at more attractive multiples. The leverage is not the same with larger companies. So we like the opportunity set of emerging managers in terms of the sourcing and the kind of companies that they end up investing in. We think it adds great portfolio diversification for our clients. We like the alignment. These managers are really not in the fee game.
Sorry, guys. I don't know what happened.
We know that there's sensitivity towards fees, and these managers really need the fees to keep the lights on. Often, there's a disproportionate amount of their personal wealth that's tied into these companies. So the alignment is very good. There's an opportunity when you get in earlier with the manager to scale. Many of these managers start scaling, and you want the ability to grow with them. Some of them actually become oversubscribed, and it's very different when you're on the outside looking in, trying to establish what could be an impenetrable relationship if you're in there early at a pivotal time for that manager. I would say there's also an increased opportunity to secure preferred economics when you're in there early, but with size, so that you have the right level of influence. You can secure preferred economics, which we do occasionally, or preferred rights. And you want, again, the ability to scale. The whole opportunity here is to find those managers that you can grow with, some of whom will end up at the trust level with very large allocation. So there are a variety of reasons.
Maybe Sarah, those themes and objectives seem very familiar to the establishment of our emerging manager program over the years. I don't know if you want to talk a little bit about our thoughts.
I would say that's consistent with our thoughts. CalPERS has been investing with emerging managers pretty much since the inception of the private equity program, and has committed over $18 billion to emerging managers over time. I would say, in addition, that one of the things that John brought up earlier was what you heard in your listening tour was a lot of spin-outs might be happening as this generational change comes in, and the emerging manager program is a way to take advantage of that.
I think our experience certainly has been within our emerging manager program that we have been much more successful in accessing diverse managers within that universe as compared to our established managers. I think the difference in percentages for our portfolio is about, with our established managers, in the 3 or 4% range, diverse managers, but in our emerging manager pool, it's almost a third, I think. And I mean, that was one of the objectives, is finding a more diverse pool. Is that consistent with what you've seen with other LPs that you invest on behalf? That's been our experience.
Yeah, that's exactly our experience. In fact, if you look at our portfolio, the emerging manager portfolio that we built with CalPERS, the $200 to $100 million pool, the diversity numbers are close to 50%. So the diversity numbers are closer to 50% for our current $100 and $200 million program. The interesting thing there, however, is there's no specific focus on diversity. The focus is how can we identify best-of-breed opportunities and managers. And what we found is by having a very casting wide net, we end up finding some pretty extraordinary managers.
Terrific. Thanks, Jason. So maybe we can turn a bit to the business model, the fund-to-funds business model here, both from the reasons why LPs are, not just CalPERS, are choosing fund-to-funds for emerging manager programs, and then maybe we can get a little bit into some of the operational aspects of actually selecting the managers. I know you spend a lot of time on that, Jason. So why don't we start with just the why question? Why do you think, and what are some of the pros and cons of, from LP's perspectives, of selecting a fund-to-fund model to access these new and next generation managers?
I'll start with the answer the way John did. Basically, our clients have found having specialists in this area has been a competitive advantage. And why is that? It primarily comes down to the resources that are required to invest in emerging managers well. So I'll give you a few examples. Number one, sourcing. You just spoke about spin-out managers. Because we have been investing in emerging managers for almost 2 decades, we've deployed more than $9 billion to emerging managers. When that manager is sitting at a fund and thinking about spinning out, we are one of the parties that they naturally think about coming to. So we oftentimes have very early, multi-year conversations with managers as they're thinking about spinning out. So you have to have the time and resources to spend with those managers, the coffees, the discussions, the strategy sessions, which we've done, including for managers in the CalPERS portfolio. That takes time. And for right now, we're making $10 to $15 million commitments on behalf of CalPERS and emerging managers. While that's very important, I think most of our clients have decided that's not the highest and best use of their internal staff, because you all know the internal staff is very focused on making larger commitments that move the needle. We think in aggregate, these investments move the needle, particularly when capital is deployed at scale. But at this point, most of our clients have decided it doesn't make sense. So that's from a sourcing perspective. The next point is from a diligence perspective. And what's different about evaluating an emerging manager versus an established manager is oftentimes when you have an established manager, a lot of the information is known, and it's known to be correct. That's not the case for many emerging managers. So many times we may meet with 20 managers to make one commitment on behalf of CalPERS and other managers. So if we need to see all of those managers and then dig into the details, we need to confirm, is the track record really as presented? Is the information that the manager has said, are these deals that this person has really worked on? All of these things that are not necessarily questions for established managers are things that we have to dig deep and evaluate, and that takes time. The next point that I would make is from a scale perspective. Our client selects this business model because we are able to aggregate a number of clients together, and then we're able to go to managers and negotiate lower fees, lower carry. And that has been very valuable for our clients as opposed to doing that separately. The final point that I'll make are all of the additional services, and I'll call these the under-the-radar things that people don't think about that go into investing in emerging managers. So with GPs, we're actively leveraging our operational due diligence team to give suggestions on how to write their valuation policies, or how to think about who can wire funds from their capital accounts. But it also includes raising their visibility with other limited partners and helping them find ways that they can talk more about their strategy at conferences. But then there are CalPERS specific items that we're focused on. The diversity survey, the cash flows that we're asking managers to provide us on a regular basis, developing a list of potential transition managers and sharing that with the private equity team, and helping with the emerging transition and diverse manager data. All of these things play into it. So you put all of that together. Clients have decided we think this activity is important, but we don't necessarily have any resources to do that full surround sound kind of approach, and so they've selected the comprehensive model.
I would add, just for context in terms of our platform, we're invested in about 425 managers. We're in 900 funds. We average seeing 2 managers a day, so 500 to 600 managers a year. We have 2,500 managers, a small number of managers in our database. We have an open door policy. There's just a lot of traffic, as Jason alluded to, in order to narrow it down to making that selection. So there's a huge resource commitment that's required on behalf of the client that they have to consider. We have 49 professionals that spend full time scouring the country, meeting with these managers. We're active in conferences, et cetera. So there's a big workload associated with it.
Yeah, I think you're mentioning when we met in New York that how many managers a day do you see? You actually see managers each day, right? Yeah, every day. Two managers a day. Yeah, to do that. Well, I want to turn a little bit to kind of sizing and scale. And maybe as part of that, Derek, I could start a little bit with, we didn't get a chance to talk about co-investments, and that's an area where some LPs are layering into the fund-to-fund investment model the ability to either structure and or help evaluate co-investment opportunities coming out of these smaller funds.
Yeah, so through the ecosystem that we've developed with the primary fund commitments, we are seeing one opportunity every single day to co-invest in. In terms of frequency, we have averaged closing on a co-investment every 21 days for about 8 years straight. So the deal flow is robust. I might add, we believe we're closing at below market entry multiples, and believe we serve it with the use of leverage. It is a great way of getting to know the managers. Number one, it's a great way of averaging their costs down. 85% of the practice is in the middle market, so we're working with the small and emerging managers. We don't think we're subject to adverse selection. They care about the deals that they're showing us because they care about the overall relationship and their ability to raise successive funds. So when we're aggregating a variety of clients into that special purpose vehicle that then in turn makes an investment into their company, they're getting exposure not only to us but through our platform. So we find it's a very robust business.
Great, thank you. Thank you, Derek. And before we perhaps, I would like to talk a little about scale, maybe what other LPs are doing. But before I get to that, maybe Sarah, just talk a little bit. I think one of the, if you had to put a pro and a con, if you had to put the con next to the fund-to-fund model, might be cost. It's a more expensive model than investing directly with a single GP in an underlying fund. Maybe you can talk a little bit about why CalPERS has weighed the cost factor, mostly for all the reasons that you've heard so far, how we think about that.
So yeah, so we have looked at this a couple of different times, and for a lot of the reasons that were discussed earlier, have come to the conclusion that paying an additional cost, although we have negotiated a fairly attractive deal with Grosvenor, that the benefit we get from having them due diligence and review 400 investments to make 4 in a year, which is sort of the ratio in the fund of funds for us, that's worth the cost of that for them to do that initial screening for us and provide us with a more concentrated group of managers to look at is worth the benefit. We also did a review with Cambridge Associates a few years ago about different business models of looking at emerging managers and came to the conclusion that continuing with fund of funds was the best way.
Great. Now, looking to the future, and again, here's where I'm going to ask some questions about scale. I'll give the board a 2-minute warning. I was going to look to President Fechner, but let him know that the opportunity for, there he is, there'll be opportunity for questions after this next question or two, just so you're thinking. So opportunities looking forward, CalPERS really structured our fund-to-fund program with Grosvenor at a fairly modest amount. We have about $300 million committed to the program going forward. And part of the thought there for CalPERS was, number one, we had the $5 billion worth of exposure already with emerging managers that Sarah mentioned. So we had a very strong amount deck to emerging managers that we've accumulated over the last 20 plus years. So I think the team was mindful going forward to think of our overall exposure. So that's one. And the other, I think the second piece was to maybe walk before we run a little bit in this new mandate going forward. But certainly in my discussions with Sylvia at Texas Teachers and looking at some of the other programs and our own desire to get more capital put out not only in private equity but within our emerging manager and transition program, maybe you can give us some thoughts about scale and the amount of capital and how that affects your mandate, not just with us, but in general with the things that you're able to do for LPs.
Yeah, so Eric mentioned it earlier. One of the questions that people often ask is, are there sufficient number of strong, attractive emerging managers to deploy capital. And Derek mentioned we do have a client where we're investing several $100 million in venture. They publicly said it $400 to $500 million a year in private equity and real estate. And we're deploying that capital now, and we don't have enough for the strong managers we try to pursue. So hopefully that puts it in perspective. That's the aim of the business. What we would say is currently the program that we have with CalPERS is focused primarily only on primary funds, and that's only on first funds and second funds. What we would say is there's a huge opportunity to do a number of things. One is to include co-investments. Your team, as well as our team, have said very strongly co-investments are an attractive way if done the appropriate way, and if focused on the appropriate risk mitigation, it's an appropriate way to potentially reduce costs, but also strengthen the relationship with managers. We think that's a very key opportunity that would allow us to deploy more capital in managers that you have already made commitments to. Because what the state of the world is today, and you make a commitment to a manager, that manager comes and brings an extraordinary opportunity, even though CalPERS has been crucial for that manager's development, we can't capture that return from a co-investment standpoint separate from the investment opportunity that's involved. So that's a consideration. And that's one of the things that we think about. Also, with a larger amount of capital, what we're able to do is go to the managers earlier on and say, we'd like to make an investment potentially on behalf of CalPERS, but in exchange for that, we want lower fees. We want lower carried interest. It's harder to do that, honestly, if it's in the $15 million commitment. It's been done, but it's harder. It's easier to do that when we have a large amount of capital that we can seem to plus aggregate with some of the other clients.
Anything else? Sarah, do you want to, any comment on sort of looking out over the next 5 years in the program?
So I guess I would say that if you look back at how much capital CalPERS was deploying in the time frame that we made the $300 million combined commitment, that was in a context of less than $5 billion over that time period. So $300 million out of $5 billion was sort of the ratio then. We are making larger commitments now, so if you wanted to keep the ratio similar, it would make sense to have a larger commitment to emerging managers. And I think we want to continue the same strategy in the emerging manager program we have in the main program, which is larger commitments to fewer managers. And so if you want to do $40 million commitments in the emerging manager space, that would imply that you would have a little bit larger commitment.
All right, board members, now it's time for questions. Anybody have any? Priya?
Yeah, I have maybe a comment and then a question. So first, it seems like this is also really essential to having a sort of a long-term strategic view that obviously the smaller managers of today, hopefully some of them will grow to be the larger managers of tomorrow. And you said that a couple of times. But it does seem important to me to establish relationships early and to be able to leverage that later on or capitalize on that later on. I want to come back to sort of your last comment, Sarah, about the larger commitments in this space, and I'm wondering why we would want to necessarily mirror that in this program. I'm not sure what the size of the funds in total. I'm not sure how if they're growing significantly in this program.
So I guess larger in the context of if they're being made at $10 or $15 million in the fund of funds now, maybe that should be more appropriately $30 to $40 million. So not not hundreds of millions of dollars per fund, but instead of 15, maybe 30 in the context of a $500 million fund.
As opposed to increasing the number of managers we would invest with?
I think you run the risk there of having a very large pool of emerging managers that don't make it into CalPERS portfolio directly because we're trying to concentrate the portfolio. And so if you have a concentrated strategy for your emerging managers, it makes it an easier conversation about the expectations for getting into the portfolio directly.
And we also subscribe to a philosophy of fewer, better managers. When we're allocating $10 to $15 million, we're not putting ourselves in a position to have real influence. And as John heard on the listening tour, there's a lot that comes with the CalPERS commitment in terms of reporting and the requirements. And for $10 to $15 million, there's a set of managers who are really overperforming, who say that that burden for that commitment at that size is not great enough. and so they end up not coming into the program.
Okay.
And the other thing that I would say is we're seeing increasingly larger number of managers raising capital at fund sizes of $500 million plus. So
Okay.
even if it went up to $40 million, it doesn't have to be for every investment. That's still less than 10% of the fund. So
Okay.
you're not taking an over-concentrated risk in a specific manager.
Thank you. That's really helpful. I have one other question for Mr. Jones and Mr. Howard. To what extent are you seeing, one of the things that Mr. Cole mentioned earlier was millennials are having more of an influence in sort of how their values, et cetera, are going to play out in the marketplace. To what extent are you seeing that in this space, particularly around environmental, social, governance issues and how that's being incorporated into investment strategies?
Yeah, so where we're seeing it actually is in a number of ways in the types of strategies that some of our managers are pursuing. So for instance, if you look at, while it's not exactly ESG, a number of the portfolio companies and managers are very sensitive to where are they deploying capital in companies that are consistent with, let's say, having an appropriate supply chain that people are very focused on in terms of how products are actually made. So that's the social piece, if you will. They're very focused also on how can they increase the focus on environmental protection within their portfolio. So for instance, as part of our investment process, we have an entire ESG process where we go through, ask the managers to fill out a complete survey, et cetera. So that's being incorporated into the investment approach to ensure that we're being thoughtful about all of those ESG considerations. I wouldn't necessarily say it's being driven by millennials, if you will, but it's really being driven by an overarching view within the investment community that ESG is important, and it's very important for us and has an opportunity to help enhance returns. Even if it doesn't enhance returns, it's a potential risk mitigator, which is also very important for us to consider.
JJ, then Richard.
I have a number of questions, but a lot of them can go to the afternoon panel. But in your mandate for us, do you pick the managers or do you refer them to us and we pick?
We pick the managers and we do the underwriting, and then we make the recommendation.
When you say you make a recommendation, does that mean we ultimately?
We have discretion.
You have discretion, okay. And then, John, on your slides, needless to say, they raised a few questions. But one of the things that I noticed is on slide 4, which was the history, you had no reference to when we looked at the merchant bank. And it could be just timeline or, the timing. But looking at the SWOT analysis, one of the things that I noticed is there is no discussion there of an opportunity of bringing it in-house, doing it in-house. But we can talk about that one later on. I just want to notice it was missing.
May I address that right
Sure.
now? We'll talk about that before the panel begins, actually in the afternoon, but we very much want to focus on that specific far right on the continuum. So we'll be very specific about that right after lunch.
And then on governance is listed as a weakness on slide 4. Slide 6, you talked about timely and expert decision making. Since staff has the ability to make a $2 billion commitment and tell the board about it afterwards, can you explain to me what the governance problem is and what the decision making timeline problem is?
That's multifaceted. So that one I'm going to kick to the panel because we will discuss it in the context of the many decisions that are faced by both the board and the staff in actually executing the strategy.
Okay, and the one other observation, and the rest I think can easily be deferred, is you talked about California, and yes, I understand why we want to invest more in California, but we should never forget that that actually is kind of doubling down, because if our portfolio is heavy in California investments, it will do well when California is doing well, which is the easiest time for the employer to make the contribution, and vice versa. We will need higher contributions at the time when California is in the worst shape.
I urge you to make that point with the panel, but specifically, in my reference, was about the opportunity to invest companies that are domiciled in California, which isn't the same as owning buildings in Los Angeles and San Francisco. But we want to drill down on exactly that point.
Okay. And the rest of these can wait, but there, just so you know, there are a few.
Richard? Anybody else?
Great, terrific. Thank you so much, and thank you, Derek and Jason, Sarah. Thank you for coming, and thank you for pitching in. Appreciate it.
Join me in thanking the panel, please. Okay, so that brings us to our lunch period. We're going to take an hour lunch break. After lunch, we'll be right back in this room, continuing on with the private equity discussion. So everyone enjoy your lunch.